So Bitcoin just completely blew past the $76,000 mark, which is, I mean, by all traditional financial metrics, that really shouldn't be happening right now.
No, not at all. It's honestly baffling if you're just looking at textbook macro.
Right, because we are basically staring down the barrel of some severe geopolitical tension, like specifically those escalating signals between the US and Iran. And, on paper, this is exactly the kind of macro environment where speculative assets are just supposed to, well, roll over and die.
Yeah, they usually get crushed.
Exactly. Yet, here we are, it's Wednesday, April 22nd, 2026, and the market is just completely defying financial gravity.
It really is a profound structural contradiction. I mean, you look at the dashboards today and you've got multiple asset classes practically screaming completely conflicting narratives at us.
Yep.
You have risk assets pricing in this really aggressive expansion, while the traditional safe havens are just quietly preparing for a massive liquidity shock.
Which is exactly why you're here with us. So welcome to today's deep dive. We've got a really dense stack of materials on the desk today to help us, navigate this exact tension for you.
It's a lot to get through.
It is. We are pulling data from a recent edition of the Crypto Pulse newsletter, and we're synthesizing that alongside some incredibly detailed summary notes from two major financial analysts, Benjamin Cowan and Altcoin Daily.
Really heavy hitters in the space.
Totally. And our mission for you today is to basically decipher these violently colliding signals. Because we've got crypto momentum doing one thing, gold's historical pattern suggesting another, and then, the Federal Reserve is just hovering over all of it.
Looming over everything, really.
Yeah. Okay, let's unpack this. Starting with the immediate pulse of the market, let's look at the actual plumbing of this current Bitcoin rally, because the numbers look right.
Oh, the top-line metrics like undeniably bullish. I mean, the broader crypto market has officially exited that extreme fear territory that it was anchored in for weeks. We are seeing a really steady grind upward.
Yeah, and the Crypto Pulse newsletter points out that reclaiming that $76,000 level, it mathematically opens the door for a push toward the $85,000 region before the month even closes.
Right.
And like I mentioned, this is happening despite the geopolitical backdrop. And usually, when an asset completely ignores bad news, the standard read is that there's just immense, unshakable underlying demand. Like, people are just aggressively accumulating regardless of what the macro headlines say.
Yeah, that's the conventional wisdom for sure. But if you look under the hood at the actual market mechanics, a very different picture emerges.
Okay, lay it on us.
Well, the newsletter highlights a massive caveat, which is that trading volume is terribly weak right now. And when you have low trading volume, price action becomes incredibly deceptive. Market makers, naturally, they widen their spreads when there isn't a lot of activity.
Right, because they don't want to take on the risk of holding an asset they can't easily offload.
Precisely. So the order books just thin out. They become full of these air pockets.
Yeah.
In a normal high volume market, it takes massive capital to move the price. But in a low volume environment like we are in right now, a single algorithmic trading bot executing a moderate buy order can just eat through multiple price levels instantly.
Oh, wow.
Yeah, it causes a price spike that looks like aggressive momentum on a daily chart, but it's actually just a complete lack of resistance.
That makes perfect sense. I was reading these notes and thinking about this price action, and it feels exactly like driving a car and hitting a patch of black ice.
Oh, that's a good way to look at it.
Right, like you press the gas, the wheels spin freely, and the speedometer just shoots up.
Yeah.
The dashboard is telling you, hey, you're going fast, price is going up. But because there is absolutely no traction, which, in this case is the trading volume, you aren't actually gripping the road.
You're just floating.
Exactly. You are just gliding on an air pocket. The slightest tap of the brakes or, one unexpected massive sell order, and you are going into a nasty spin out.
Mm-hmm.
In market terms, we're essentially looking at a classic bull trap.
What's fascinating here is how perfectly that captures what institutional traders call the split scenario. You have short-term momentum completely favoring the bulls, largely propped up by broader market conditions, like equities are holding up and those tense energy markets are keeping nominal prices elevated.
Yeah.
But when you zoom out to higher time frames, the lack of volume or the lack of traction on your black ice, it suggests extreme caution. If genuine organic capital doesn't step in to replace the speculative algorithmic trading, we risk falling into a liquidity trap.
Yeah, that's bad.
Very bad. That's when the algorithmic buyers shut off, and because the order book is hollow underneath, the bottom just completely falls out.
Okay, so if the crypto order books are full of air pockets right now, and Bitcoin is accelerating on black ice, where is the actual heavy capital deploying? Like, where is the traction? Let's shift our focus to Benjamin Cowan's analysis from today, because he is looking at the macro heavyweight, which is gold.
Right, and Cowan's perspective provides a really necessary reality check here. Gold recently experienced a significant structural pullback, dropping roughly 25 to 30%. Now, for retail observers, a 30% drawdown looks like a catastrophic trend reversal.
Oh, absolutely. If your portfolio takes a 30% hit, panic naturally sets in. I mean, you think the sky is falling?
Of course. But Cowan argues that macroeconomically, gold is still firmly entrenched in a long-term uptrend. He points out historical data from the 1970s and the 2000s. In both of those inflationary decades, gold experienced severe, terrifying short-term pullbacks right in the middle of massive bull runs.
Oh, really?
Yeah, they were shakeouts, not the end of the trend. And the critical data point he highlights is that despite this recent drop, gold is still structurally outperforming the S&P 500 over recent years.
Wow. While Bitcoin, interestingly enough, is underperforming gold right now and really struggling at key resistance levels, which actually this brings up an argument I see constantly in the crypto community, and it's heavily referenced in Cowan's notes.
The symmetry argument.
Yes. There is this pervasive, almost like protective logic that says, well, Bitcoin didn't rise as aggressively during the last mini rally, therefore it won't drop as hard when the broader market finally turns. And I just have to actively push back on this because it's fundamentally weak logic.
It's the myth of symmetrical returns. The market simply does not owe you symmetry.
Exactly. It's sunken cost fallacy combined with wishful thinking. Like, past market cycles prove time and time again that a sluggish asset on the way up does not suddenly develop a parachute on the way down.
No, it really doesn't.
When a macro sell-off happens, the algorithms don't care that your asset underperformed last month. Gravity applies equally when the floor gives out. Small rallies can absolutely lead to devastating declines.
And that ties perfectly into Cowan's final takeaway regarding the macro battlefield. When you have this level of global uncertainty, capital preservation takes priority over capital appreciation. The environment fundamentally favors a traditional safe haven like gold over a risk-on asset like crypto.
Right.
But he notes an essential mechanism about how gold behaves during a true recession. Historically, gold bull runs are often interrupted by recessions.
Wait. I want to stick on that for a second because intuitively, people think a recession hits and everyone immediately runs out and buys gold. But that's not what actually happens, is it?
No, it's not. In the immediate onset of a recession or a sudden market shock, you get a liquidity crisis, a dash for cash. Institutional funds are facing massive margin calls on their equity portfolios.
Because everything is tanked.
Right. And to cover those losing positions, they are forced to sell their highly liquid, winning assets. Gold gets sold off in the panic just to raise physical cash.
Oh, I see.
But once the central banks step in to provide liquidity and fight the recession, gold is historically the first asset to recover and violently push to new all-time highs. It's a pure reflection of the market pricing in the currency debasement that inevitably follows the panic.
Okay, so that perfectly tees up our next variable. If gold is positioned to win the macro war because of impending uncertainty, what forces that eventual pivot? Like, what injects that liquidity back into the system? We have to look at the Federal Reserve.
They are the ultimate catalyst. They dictate the cost of capital globally.
And this is where Altcoin Daily's analysis comes in, because the macro weather is about to change. We have an incoming Fed chair. According to the summary notes, this new chair openly accepts crypto as a permanent fixture of the financial system.
Which is huge.
It is. That alone is a massive pivot from the historical hostility we've seen from regulators. But more importantly, he actively opposes the creation of a central bank digital currency, or CBDC.
Which represents a monumental structural advantage for private networks. If a central bank issues a CBDC, they have absolute control over digital monetary rails.
Right.
By stepping back and refusing to build a monopoly digital currency, the Fed is essentially leaving the playing field completely open for existing infrastructure, like Bitcoin and Ethereum, to act as the primary settlement layers.
Now, really quick, before we dive into the mechanics of interest rates, we need to make something explicitly clear to you listening. The sources document that there is currently immense political pressure on the Fed to drastically cut borrowing costs and ease rates.
It's all over the news.
Right. And we are absolutely not taking any political sides here. We aren't endorsing any specific policy, left or right. We are merely reporting on how the bond markets and institutional traders are interpreting these political dynamics as a highly probable catalyst for upcoming rate cuts.
Right. And this raises an important question. What actually happens to institutional capital allocation when those rate cuts collide with our current economic reality? Because it's not just about money becoming cheaper to borrow.
No, it's deeper than that.
Altcoin Daily points out a very specific, volatile combination, which is impending rate cuts combined with structurally elevated inflation.
This is where we get into the mechanics of negative real yields. Let's look at this from the perspective of an institutional treasury manager, right? Someone who manages billions in corporate reserves. They have a fiduciary mandate to beat inflation.
Right. They have to preserve purchasing power.
Exactly. So if inflation is running at, let's say, 5%, but the central bank cuts interest rates, so government bonds are only yielding 3%, you have a negative real yield of minus 2%. It's like keeping your savings in a leaky bucket.
You are experiencing capital rot. The purchasing power of your treasury is actively deteriorating while sitting in safe haven government debt.
Exactly. It's mathematically guaranteed loss. So what happens? That treasury manager is systematically forced further out onto the risk curve. They literally cannot hold cash or low-yielding bonds. They have to hunt for assets with a fixed supply that can outpace the monetary expansion.
Yep.
That capital rot is what physically forces institutional money into hard assets, real estate, and ultimately Bitcoin. It's not a speculative choice. It's a defensive mandate.
And if the incoming Fed chair caves to that pressure and maintains a highly reactive, data-driven approach, cutting rates aggressively at the first sign of economic slowing while inflation remains sticky, the market practically guarantees that negative real yield scenario.
Which changes everything.
Altcoin Daily argues this specific bond market dynamic is the fundamental fuel that ignites major crypto rallies. It forces liquidity out of the traditional banking system and into alternative assets.
But when that capital is forced out onto the risk curve, it's not just blindly buying digital gold anymore. If we look at the social sentiment section of the Crypto Pulse newsletter, the narrative beneath the surface is radically shifting. The actual destination for this liquidity is evolving. We are seeing a massive shift toward Ethereum as what the sources call productive money.
And this requires a fundamental shift in how we categorize assets. You have to contrast idle assets with productive ones. Gold, despite its rich history and macro utility, it just sits idle in a vault.
Right, doing nothing.
Exactly. It does not pay a dividend. It doesn't generate cash flow. Bitcoin operates on the exact same economic model. It sits idle on a cryptographic ledger. Its value relies entirely on price appreciation.
Meaning someone else has to be willing to pay more for it tomorrow than you paid today.
Right. It's a pure monetary premium. But Ethereum is attempting something entirely different. It generates organic yield.
Yeah, the newsletter refers to it as becoming the underlying backbone for stablecoins and tokenized traditional assets. Every single time a transaction happens, whether it's trading a token, transferring a stablecoin, or executing a smart contract, a fee is generated. It essentially turns the Ethereum network into a global financial toll road.
And to really understand why institutions care about this, we have to look at the mechanics of proof of stake. This isn't just a passive toll booth. To collect that yield, participants have to stake their ETH, effectively locking up their capital as a cryptographic security bond to guarantee they will process the network's traffic honestly.
And if they act maliciously, that bond gets slashed. Like they lose their money.
Correct. So the yield they earn isn't just some artificial dividend. It's a direct programmatic payment for providing economic security to the network. Plus, a portion of the base fee from every single transaction is permanently burned, effectively removing it from the total supply.
Right.
So you have a deflationary mechanism colliding with real cash flow.
Okay, here's where it gets really interesting. If Ethereum operates as this global financial toll, road generating a compounding yield from constant user traffic while simultaneously burning supply, shouldn't institutional investors stop viewing it merely as a speculative token and start modeling it more like a massive high-growth tech stock, like a decentralized Amazon Web Services?
That is exactly how Wall Street is beginning to model it. Traditional finance relies heavily on discounted cash flow models, or DCFs.
Right.
You couldn't apply a DCF to Bitcoin or gold because there's simply no cash flow to discount. But with Ethereum, you actually can project network revenue. Institutions are trying to balance a hybrid asset here. On one hand, Ethereum is fiercely competing for that monetary premium, the store of value status. On the other hand, it is highly productive.
Which is a killer combination.
If a fund manager can hold an asset that captures monetary debasement and pays a compounding 4 or 5% yield just for providing network security, it fundamentally alters their portfolio math. The newsletter specifically notes that institutions are actively migrating from a Bitcoin-only thesis to including Ethereum as a core holding because of this exact cash flow dynamic.
But DCF models require actual revenue, which means you need actual traffic. We can talk about theoretical toll roads all day long, but is anyone actually driving on them?
Well, yes.
Let's transition over to the news overview section, because this theoretical utility is actively infiltrating the real world right now.
And we are seeing that infiltration at both the consumer and the institutional levels.
Mm-hmm.
The DoorDash headline is a perfect example of this. They are partnering with a company called Tempo to test stablecoin payouts.
This is massive because it's completely mundane.
Yeah.
This isn't a hedge fund moving $1 billion across borders to evade taxes. This is a gig worker delivering a burrito and interacting with cryptographic rails just to get paid faster and with lower fees.
It's marketplace utility functioning quietly in the background.
It's the normalization of the technology.
Yeah.
Similarly, on the institutional trading side, the headlines note that Kalshi, which is a major regulated prediction market, is exploring crypto perpetual futures. They are actively building the infrastructure to compete directly with native crypto trading giants.
Yeah.
The traditional financial plumbing is just aggressively bleeding into crypto finance.
But then you zoom out to the sovereign nation-state level, and the integration gets incredibly messy. Look at the geopolitical news here. Russia is advancing a sweeping crypto bill that officially allows the use of digital assets in foreign trade. And the hypocrisy here is just staggering.
Oh, it really is. You have a nation actively, enthusiastically utilizing decentralized crypto networks to bypass global financial restrictions and settle trades with international partners. They are leaning into the permissionless nature of the asset. But in the exact same legislative framework, they are strictly banning their own citizens from using it for domestic payments to prevent capital flight. It's literally crypto for me, but not for thee.
It is the ultimate state-level arbitrage of financial freedom. If we connect this to the bigger picture, we are witnessing a deep bifurcation in how this technology is applied.
How so?
Well, on one end of the spectrum, it is sneaking quietly into the friction of everyday life through consumer apps like DoorDash. On the other end, it is becoming a highly weaponized geopolitical tool for sovereign nations. And somewhere in the middle, it is still subject to incredibly complex, centralized human drama.
Right, like the final headline in our stack today. Justin Sun suing World Liberty Financial, or WLFI. He's claiming his tokens were unfairly frozen and his governance rights were completely stripped away by the protocol.
It's a stark reminder that while the underlying blockchain technology might be decentralized and immutable, the human elements wrapping it, the governance structures, the legal entities, the protocol administrators, they are still highly centralized points of failure that inevitably end up in traditional courtrooms.
So what does this all mean? Let's synthesize this journey for you. We started this deep dive looking at a massive market contradiction. Bitcoin accelerating past $76,000 on black ice, showing us rapidly rising prices but fundamentally hollow order books and terrifyingly weak volume.
Right. And from that immediate illusion, we zoomed out to the macro reality. We saw that in a true liquidity crisis, uncertainty fundamentally favors the proven historical resilience of gold over the speculative hope of crypto.
But we also identified the looming catalyst capable of flipping that environment. We have a new crypto-friendly Fed chair, intense political pressure for rate cuts, and the very mathematical reality of negative real yields. That capital rot in the bond market is the exact mechanism that historically forces a tidal wave of institutional liquidity out of cash and back into fixed supply assets.
And finally, we tracked where that liquidity is likely to flow. We moved beyond just digital gold to explore the evolution of productive money. The realization that assets like Ethereum are functioning as compounding financial toll roads, generating real yield, and actively integrating into everything from gig economy payrolls to international trade settlements.
Which is exactly why you need to understand the mechanics behind these headlines. You aren't just watching ticker symbols bounce around on a screen. You're actively witnessing the real-time maturation of an entirely new asset class, one that is fundamentally rewriting the plumbing of traditional finance, from how a DoorDash driver receives their wages to how nation-states bypass global sanctions.
And I will leave you with one final paradigm-shifting thought to mull over, building on that idea of the financial toll road. If a decentralized software network can successfully and securely generate a consistent compounding yield based entirely on transparent global network traffic, and if central banks continue to manipulate their traditional fiat currencies through discretionary rate cuts and inflation, What happens to the global financial system when a borderless piece of software starts offering a more reliable, more globally accessible interest rate than the Federal Reserve itself?
Now, that is a question that changes the fundamental physics of money. We started today looking for traction on black ice, and we might just find that the entirely new decentralized road being built underneath it is the only safe place to drive. Thank you for diving deep with us today. As always, trust the data, but keep questioning the consensus. See you next time.